Hey everybody, I'm Mike DeSepoli and welcome to the Heritage Market Pulse for Friday, December 17th, 2021. We hope you had a great week. We wanted to update you on the markets where they sit right now, just about 37 minutes before the close. We're seeing some interesting action in the market today. We want to discuss it with you. First and foremost, obviously, COVID is taking center stage yet again in the news as case counts continue to rise. And we mention this because it's fueling what we think is a very important shift in the market. A shift that we believe has been underway for the last couple of days, and we want to touch on that with you a little bit today. What we've seen in the market is a lot of volatility since the Fed press conference on Wednesday, right? We had Jay Powell speak at 2:30 on Wednesday. We had a massive rally that unfolded thereafter and had a lot of people feeling good going into Thursday when the markets got crushed again, right? So that is really just a move that you see that tends to just demoralize investors, right? Because they're feeling good. They feel good about the message from the Fed. They think that we have the all clear signal, and then the markets trend lower on Thursday and take out Wednesday's lows, right? So we want to talk about that because number one, we totally understand the feelings that correspond with those types of moves in the markets. But number two, we want to talk about how this is very normal part of a bottoming process. Now, we talk about a bottoming process. We talk about the markets trying to reverse their move downward, find some stability, find some footing, and move higher. And it's important to remember that bottoming is a process. It generally tends not to happen in a V-shaped format where we go from down to up, 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 and away. And we want to point our viewers here to some examples of this from earlier in the year. Let me just move that. Now, we have had several bottoming processes this year in the markets, and as in many years in the markets, right? The market doesn't always just trend up and to the right. We tend to go through many corrections, some more truncated corrections, some a little bit larger. But what we generally tend to see, and we try to highlight this in these boxes on this chart, is we have a scenario in every instance that we've highlighted here where the market trended low into an intermediate term low. With the white candle, if you will, was a big bounce, right? A big rally in the market where people felt we're back, the bulls are back, we have the all clear signal. And then the very next day, the market again flushed out to new lows and left many retail classical investors saying that we just broke the recent lows and the market is doomed for more pain ahead. And as we can see, what happened each instance that we saw that after that second breakdown, the markets found its footing and started a strong rally. So what happened here, just really yesterday, today's Friday, so we're talking about Wednesday into Thursday, looks to us very much like what we saw happen in March and what we saw happen in late September and early October. And obviously time, a couple days and a week or so, we'll be able to tell if this is a signal that we can rely upon, but we believe that we're getting a signal from the market that the market is trying to find its footing. Now, what we want to point our attention to today is the fact that this market is very divergent yet again, except this time it is the NASDAQ that is showing gains on the day, the technology sector, the growth sector, and it's the Dow Jones that's down 380 points sitting here at current levels at 3:25 p.m. I point this out to you because when we look at the Dow Jones, it's more linked to travel and reopening of the economy. And as COVID cases continue to rise, that should be the index that gets hit harder. Whereas the NASDAQ, which has been taking a hit because of the fear of higher interest rates, we think is primed for a very big rally. Now, when we look at the interest rate market, right, we've done this a couple times over the last few days. Our 10-year yield is once again telling a story that the market does not believe that rates will be moving higher. Okay, down slightly on the day, but the big news is this market and this interest rate environment on the 10-year Treasury is down substantially over the course of the last 2 months, and it's down even since the Fed's policy meeting on Wednesday when they hinted that rate hikes would happen at some point in 2022. This is the market telling, the bond market that is, telling the equity markets, we don't believe you. Okay, and the bond market tends to know. It's been a very reliable barometer in the past, and we think it will be so again in the future. Well, we want to look today at a particular fund. Now, this is a fund that encompasses many stocks that we own, many stocks on the growth side, software side, innovation, right? This is the ARK Innovation ETF. Now, we point this to you not as a major portfolio component for us, but as something that is representative of a lot of the stocks that we own. And we see today, this is a very big reversal, a very big divergence to see a fund up 5.24% in a market where, yes, the Nasdaq's higher, but only by 19 points, and the Dow Jones and the S&P are lower. We think this is the signs that you see at the bottom, where just this morning, this fund was down again in a big way and has reversed in very strong fashion. And this is the type of activity we see at bottoms. Now, again, why the ARK Innovation ETF? We think it's very representative of the area of the market that has been left for dead over the last couple weeks, if not the last month or so. Now, I think one of the biggest tricks that the market has ever played on folks is convincing them that the COVID economy and a pandemic is the only environment where growth stocks, software stocks, and tech stocks can succeed. People so quickly forget that from the period of 2016 through 2020, before the pandemic, it was that area that significantly outperformed the S&P and the Dow. So we think that the stage is set for this type of rally to unfold yet again. Generally, the market has a way of being very cruel and very mean and trying to scare people out of their positions so they can force selling and accumulate cheap shares for the larger institutions to hold on to for the next move higher. So that's what we're seeing here in the markets today. Again, COVID dominating the headlines once again. I feel this is something we're going to be seeing for the foreseeable future. It appears there's a seasonality to this. As we move further into the winter, we're seeing cases rising. Again, that's something that remains to be seen what the impacts are. But we know the playbook from last year. The more persistent COVID became, it was the NASDAQ index that was leading the way because those were the companies that were keeping businesses afloat, keeping them to be able to communicate with their customers through, regardless of conditions, regardless of restrictions. And we think that that's the case here yet again. So if you have any questions, reach out to us. We understand how rough that this volatility is and can be on investors. But it's important to us. We want to convey to you our confidence both in these markets, broadly speaking, as well as the investments we own, which, yes, in the short term, many of them do not look good, but in the longer term view, they are very much intact. They represent phenomenal opportunities for forward-looking returns, especially when we look at the levels we're at now from a risk-reward basis. We think that the market and the reward is much more of a greater opportunity here than the risk that a lot of these stocks present. So if you have any questions, reach out to us. We're always here for you. We'll see you back on Monday for the Heritage Market Outlook. We hope you have a great weekend.